The Roth TSP is a great tool to create tax diversification in retirement, but it's also an underutilized tool by many federal employees. In this video, we'll discuss why the Roth TSP may be a good option for you, and we'll address 7 common questions that people have about the Roth TSP. That's coming up, so stay tuned. Hi, I'm Jarrell Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you're new here, consider subscribing. Deciding whether to invest in a Roth TSP often comes down to a discussion about taxes. The conversation typically focuses on whether a person will be in a higher or lower income tax bracket during retirement, and whether future tax rates will be higher or lower than current rates. And while that conversation is important, it's very possible that during a 10, 20, or 30-year retirement, there may be periods when your income or prevailing tax rates may be lower, higher, or even similar to what they are today. So rather than focusing on either or, a better conversation may focus on how to create tax diversification that positions you to benefit from a traditional TSP, Roth TSP, IRA accounts, or even non-retirement accounts. So before I address some common questions about the Roth TSP, I want to briefly explain what tax diversification is and why it may be important to you. Tax diversification is a strategy that considers various tax treatments of the investment accounts you will eventually use for income after you stop working. Tax diversification, when coupled with a tax-efficient withdrawal strategy, can help lower your overall taxes in retirement, and it can help your assets last longer in retirement. Here's a quick refresher on the 3 types of tax accounts. There are non-retirement accounts, which are also referred to as taxable accounts. These accounts are funded with after-tax contributions, but the paid out interest, dividends, and capital gains are taxable in the year in which they occur. Brokerage accounts and banking accounts are examples of non-retirement accounts. The next group is tax-deferred accounts. These accounts may be funded with pre-tax or after-tax contributions, and they typically provide an upfront tax break. The earnings and growth on these accounts are not taxed until they are withdrawn. Examples of a tax-deferred account is the traditional TSP and traditional IRA. The last group is tax-exempt accounts. Contributions to these accounts are made with after-tax dollars. However, your investments grow tax-free, and qualified withdrawals are tax-free as well. The Roth TSP and Roth IRA are examples of a tax-exempt account. Tax-exempt accounts, or tax-free accounts, which they are sometimes called, can definitely provide tax diversification to federal and retirees because the first pension, the first supplement, and in most cases, 85% of Social Security and any other earned income will be taxed in retirement. Plus, you'll pay taxes on income or distributions from your taxable and tax-deferred accounts. So now let's jump into 7 common questions about the Roth TSP. One question that we sometimes get is, am I eligible for the Roth TSP? Essentially, all federal employees are eligible to participate in the Roth TSP. Unlike the Roth IRA, the Roth TSP is not limited based on your income and tax filing status. However, you do have to take the initiative of making a contribution election to start adding money to a Roth TSP. You may choose a percentage of your salary or a specific dollar amount to contribute to the account each pay period. In most cases, the election can be done through your agency's electronic payroll system or by completing and returning the TSP-1 form to your agency's personnel or benefits office. Speaking of contributions, a second common question is, how much can I contribute to the Roth TSP? The annual contribution limit is the same for both the traditional TSP and the Roth TSP. The amount may change from year to year, but for 2022, the annual contribution limit is $20,500. If you're age 50 or older, you're allowed to make an additional catch-up contribution of $6,500 bringing the total amount to $27,000. Every year, you can contribute to the traditional TSP, the Roth TSP, or a combination of the two, as long as you don't exceed the maximum contribution limit across your entire TSP. Also, your agency's matching contributions do not count against the annual limit, but all matching contributions are allocated to the traditional TSP, no matter how much you contribute to the Roth account. Another question that often comes up is, can I transfer my traditional TSP to a Roth TSP? Unfortunately, the answer is no. That would be nice for many federal employees, but it's not an option at the moment. Additionally, you cannot transfer a Roth IRA to a Roth TSP. Currently, you can only make new contributions to the Roth TSP account, or you can transfer the Roth balance from an employer-sponsored Roth 401k, Roth 403b, and Roth 457b to a Roth TSP account. The fourth question that we're sometimes asked is, will my Roth TSP grow? It's important to note that the Roth TSP is not an investment. It's just a tax advantage account that can hold investments. When you open a Roth TSP, you can invest in any of the 5 individual funds and 10 life cycle funds. Also, if you meet certain eligibility requirements and are willing to pay the necessary fees, you can choose to invest up to 25% of your TSP savings in any of the funds offered through the mutual fund window. So ultimately, the growth of your account will mostly be determined by your contribution amount and the performance of the funds that you select. An added concern that many people have about retirement accounts is their access to the funds. So a fifth question that frequently comes up is, are there any restrictions or waiting periods to withdraw the money tax-free? The resounding answer is yes, but there's really only 2 rules that you have to remember. To withdraw the funds tax-free, which is called a qualified distribution, you must be 59 and a half or older, and 5 years must have passed since your first Roth contribution. If you meet those 2 stipulations, your distribution is not taxed under any circumstance. However, if you don't meet one or both stipulations, your distribution is considered non-qualified, and that's when you may encounter a tax situation. If you have Roth TSP money, your account is separated into 2 pools. One pool is your contributions, and the other pool is your earnings. When you take a distribution, your withdrawal includes money from both based on the percentage in each pool. You've already paid income tax on your contributions, so money coming from that pool is never taxed or penalized regardless of your age or the amount of time that has passed since your first contribution. But the portion coming from the earnings pool of a non-qualified distribution is taxed, and it may be subject to early withdrawal penalty if you're under age 59 and a half. A sixth common question that we often get is about RMDs, which stands for Required Minimum Distributions. Once you become age 72 and are separated from federal service, you're required to begin receiving distributions from your Roth TSP account. However, there is a way to get around the RMDs. The RMD rules do not apply to Roth IRAs. Therefore, when you retire from federal service or before turning age 72, you can transfer your Roth TSP to a Roth IRA and never be required to withdraw from it. Just as a side note, when you roll over your Roth TSP to a Roth IRA, the starting date for satisfying the 5-year rule does not carry over. Instead, you count from the first year you contributed to any Roth IRA. So if you already have an existing Roth IRA account, the 5-year rule will be based on when you open that account. Also, when you pass away, if your account meets the 5-year rule, your beneficiaries will enjoy tax-free distributions through an inherited Roth IRA. The last question that I want to address is really a hybrid question. So part A of the question is, should I invest in the Roth TSP? And part B is, when doesn't the Roth TSP make sense? The first part of the question is truly a case-by-case basis. That depends on several factors, but sometimes a Roth TSP may not make sense. If you're a high income earner and maxing out the traditional TSP will put you in a lower tax bracket today. Furthermore, when looking at the total amount of taxes saved or paid, you have to consider state and local taxes in addition to federal taxes. The location where you currently live or plan to retire may have a significant impact on your total tax rate. Also, if you're in a tight budget situation, you may want to consider sticking with a traditional TSP only. Investing in a Roth TSP will reduce your take-home pay, which can create more strain on your monthly cash flow. Additionally, if you've only been investing in the traditional TSP for 20 plus or 30 plus years and retirement is on the horizon, the Roth TSP may not be a good fit for you. Lastly, just because you don't participate in the Roth TSP, it doesn't mean that you totally miss out on utilizing the Roth feature. If you're under the income limitation of the Roth IRA, you can make investments through that account. You can also explore a Roth conversion from a traditional TSP or traditional IRA. As mentioned earlier, the Roth TSP is a really nice vehicle to create tax diversification and tax-free income during retirement, but it may not be a good fit for the needs or interests of every investor. We enjoy hearing from you. So if you have any other questions or feedback, please add them down below in the comment section. And if you received any value from this video, go ahead and click the like button and share our channel with others. Thanks for watching, and we'll see you on the next Money Briefing.